Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tshepho Modiba. Thanks for joining me. Tonight, I'm joined by the ever dapper Thabo Ncalo, Managing Partner at Savvy Capital Partners. Thabo, there must be some sort of dress code or something at Savvy, you know?
I've realized maybe next time I need to come with a t-shirt and jeans on or something, you know? Change the perception a bit there. But good evening, Tshepho, and good evening to everybody listening. And
thank you for joining us, man. Let's kick off the discussion. There's a continual debate that we've had on the show regularly. Naturally, the private equity guys will tell you that the best way of accessing the continent will be private equity. Sure. And the guys in the listed space will tell you the best way of accessing is on the listed space. So where do you sit in that in that debate, and how do we navigate that divide?
No, thanks, Tshepho. I mean, look, it's an important debate, you know, because I think even if you look at returns in Africa, the private equity returns versus the listed market returns, there is certainly a divergence, you know, between, you know, is one better than the other. And unfortunately, if you look at, or unfortunately for listed market, if you look at the last couple of years, you know, if you look at, for instance, reports from the likes of Safka, right. They've shown, you know, private equity, I think the last couple of over a 5-year period has returned about 18%, and about 15% on the listed space.
Why is that? Why is there this big divergence?
You know what? It's also a question, I guess, of when the performance is measured. Right. There's also that debate. You know that, look, I mean, markets might have been a bit soft at the time and so forth. But look, I think private equity has proven to add more value in the investments they make. So unlike obviously on the listed space, a lot of people put money in and sit back and let management do the work. On the private equity space, you've got an opportunity to actually be involved at one level or another in making the company a success. And I think that value addition aspect has helped to add those couple of percentage points above just being a passive investor. Right. If you also look at the second point, which is the pricing or the mispricing of securities, on the private equity market, naturally because it's a private transaction, it's a negotiated transaction, it's easier to realize your value from the negotiation itself. Whereas on the market side, if you actually believe that markets are actually efficient, then the price would be reflecting a fair price, you know. Right. And so I think that's one of the differences. Whereas in private equity, you can get a bargain, or through a private equity structure, you can negotiate a bargain. But then, of course, the perfect pricing comes from the market dynamics. Okay. So I think those have played an important role in the game, yeah.
Right, and I'd assume the debate is probably even more nuanced in that it's a function of which markets you're looking at. So in certain markets, actually, it may very well be that the listed space is a little bit better.
Correct.
Okay, I've heard this fancy term, pipes. What does that mean?
Yeah.
And how does that present a new avenue for investors?
So we've gone to market with a pipe product, and pipe essentially for everybody listening is essentially a private investment in public equities. Okay. So it sort of sits in between investing in just public equities or investing in just a private equity space. And what it is mobilizing private money that have a long-term view, more patient money, such as money that sits in the private equity space, and deploying that capital in public listed equities, but
so
doing
taking a significant stake in
taking a much more significant stake as a start, and being a lot more involved as a private equity investor would do. Right. So typically, as a listed market, if you're a mutual fund or a sort of a unit trust, we call it in South Africa, putting money in a listed company, you're going to be a minority, and you typically don't have any other voice but just to vote through either your proxies or through, you know, the normal annual general meeting situations. Whereas we believe that in Africa, the real value truly comes from you being able to add value onto the businesses and not just being passive. Right. And a lot of that we've seen. We've actually interestingly seen a lot of what we call corporate pipes, where, you know, companies, for instance, in the likes of South Africa, you saw Tiger Brands as an example, putting money in another listed company, Dangote Flour, right, you know, and taking those out. So it has been a complete disaster. We know that, but I mean, it's another example of I guess a deal went bad, but it's another example of a pipe transaction anyway that could have been structured along those lines. Right. And there have been a couple of them. You know, we've seen private equity players actually putting money in the likes of Fen Milk in Ghana. There's been a recent transaction in Rwanda on I&M Bank where there was also a private equity investor coming to list or an IPO, one of their investments.
What are the benefits of the structure for, I guess, the businesses that are being bought into and ultimately for the investors?
Sure. So one of the challenges, if you look at the private equity space in Africa, has been the question of exits. Mm-hmm. So, you know, when it's time to exit, it just so happens to be that time when the currency has crashed. So exits have been delayed, or the point of exits have been very frustrating for a lot of private equity managers. Mm-hmm. Now, when you look at the public space, the problem the public market has always faced is liquidity. Mm-hmm. In the sense that when it's time to get out, you can't get out because there is no liquidity. Mm-hmm. Particularly if you look at smaller markets like Mozambique, where there is a stock exchange that very few people know about. Malawi as an example, you know. And even if you look at a market like the BRVM in Cote d'Ivoire, there are a lot of unlisted, so there are a lot of listed but very liquid companies that are on the space. So the advantage with going with sort of this private investment in public equity is you get almost the best of both worlds, because you've got the long-term capital, the long-term patient capital that's private equity in nature, going into companies that essentially are listed, but are able to give you those private equity characteristics. And what is the biggest advantage for that? If they're already listed, then they create an opportunity for you to be able to exit. You can exit directly through either a secondary offering on the market, or just a placement of the shares that one of the investors has. So there are more natural ways to exit the stocks. And importantly for us as well is this development of capital markets in Africa. So the one thing we've seen as well is that, you know, there are a lot of nascent capital markets, very small capital markets in Africa that are just not getting off the ground. And the reason for that is the liquidity issue. And I think, you know, taking some of these companies that, you know, some listed just, for instance, to get tax benefits. If you take some of these guys and help them to actually realize the goal of why they're listed, it could actually help to develop capital markets in Africa as a whole, yeah.
Okay, so does this then mean, as an institutional investor, it opens up the opportunity to enter into stocks that you may not have looked at before because of liquidity?
Correct, yeah.
Okay, so then that leads me to my next question. What opportunities does this open up? Are there any particular companies in the continent that then this presents an interesting opportunity?
There are a lot. So the interesting thing is, and as you said, if you look at the space at the moment, a lot of equity investors in Africa, who are, let's say, a large investor through mutual funds, through various Africa funds, they typically exposed to the top names. So they call it GT Bank in Nigeria, KCB in Safaricom, you know, the names that everybody throws out there. And there's a reason for that, because, you know, obviously if you're running a mutual fund, you want to actually maintain some good levels of liquidity for your investors if they want to buy in or out, because most of these funds are obviously open-ended. And what we've seen, I guess, is that there are a lot of companies that are therefore neglected by nature of they just not being liquid enough. So there are many opportunities we're looking at. I mean, Mozambique is one. So if you want to buy a stock like Cervejas de Mozambique, where I think many listed equity managers would want to hold, which is an SAB Miller or AB InBev, a sort of subsidiary, you can't get it if you're just trying to buy it off the market, because the market is not liquid enough. Right. You have to trade through a bank and so forth. So those are the kind of transactions, for instance, in a market like Mozambique, which is small and bubbling under, that PAP transactions would be the best. And out of those, CDM is one great example. Other great markets we've been looking at Cote d'Ivoire. You know, Ivory Coast has been fascinating. And for us, the reason for that has been there are a lot of businesses that are currently family owned, and businesses that have either one single shareholder or one influential shareholder that we can engage with. Right. So Phil Tisek, for instance, in Cote d'Ivoire. In Ghana, we've been looking at a few other names that obviously we can't really speak about.
Yeah, because the price may move. Let's unpack some of the opportunities in Cote d'Ivoire that you've touched on. what are the characteristics of these businesses that make them great investments?
Sure. So, I mean, one of the things we look at is we only provide growth and expansion capital. So we look at growth and expansion capital between $3 and $30 million. And so you can imagine the type of businesses will be more in the mid-market, middle-sized companies.
Right.
So one of the key things we look at is obviously the capital structure. Can we actually add value through changing the capital structure or introducing capital into the businesses to help them grow?
Right.
So we typically want to invest in a business for them to buy out their partner.
Yeah.
The aim would be to give you money so you can grow your operations.
Right. So that then infers that you're looking at businesses that have growth potential.
Fantastic growth potential. So we're only looking at 6 particular sectors, focused on the consumer touching sectors. So sectors like retail, financial services, ICT, agriculture and agro and food.
And why those sectors?
Because we think, if you look at the space on the continent, you sort of mining has been too cyclical. And some of the other sectors, for instance, if you look at, infrastructure, it requires too much of a capital outlay.
Right.
So we're really targeting cash-generative businesses that are operating in the consumer or people-facing sectors. And there's good reason for that. It's the demographics of Africa. You look at the youthful population and what they need to be eating or how they need to be eating, where they need to be living. All of these things factor into why we look at, for instance, healthcare. We look at housing and construction. We look at retail. We look at agriculture and food. So the sectors we've chosen are essentially to tap into the changing demographic in Africa, the youthful demographic, and the changing population dynamics in Africa.
Okay. So then let's go back to, I guess, the actual businesses and how they tap into that sort of profile.
Yeah.
And I guess the actual growth opportunities. Any particular business that you'd be comfortable sharing?
Look, they're quite a lot. So
yeah.
Obviously we'll do a filter out of the, call it 1,400, 300 stocks that are listed on African markets.
Yep.
And we'll come up to names that are either small enough, that have a management team that we think we can approach through partners, and they're where we think we can add value. So the value addition part is quite important.
Yeah.
And there we're looking at names, for instance, Filtisec, I mentioned in Cote d'Ivoire, would be a perfect candidate for us. And it's a company where I can mention because we don't really have any sort of confidential discussions with them. There's another company called Benabi, also listed on the BRVM. These are companies where we'd look to do a private transaction but keep them listed. Right. So Simbisa Foods is one I really, really like. I've spoken about several times. Yeah. Listed out of Zimbabwe, but they're really growing outside Zimbabwe. And there's a perfect company that's in the retail and FMCG space, food, fast foods, and so forth. And it's a great business to tap into the type of demographic dividend that I spoke about. And
what sort of stakes would you be taking in these businesses?
So 10 to 50.
10 to 50.
10 to maximum 50, because I think we don't want to have control. We would still want to have the owners or the founders to still be involved.
Sure.
So it's a significant stake in the sense that 10% or at least 10% will give us enough of a board seat. Obviously, you have a lot of minority protection sort of clauses you can put into the agreement to protect yourself, but obviously go big enough or small enough to be able to cater for influence.
Perfect. Let's leave it there. Thanks to my guest, Thabo Ncalo, Managing Partner at Savvy Capital Partners. That's all from Buy Africa this week. Remember to follow me on Twitter. That's at Modiba_Tshepho. And Thabo, yours is?
It's at Savvy Cap Invest.
Perfect. Please send us your thoughts about the show using the hashtag Buy Africa. From myself and the team, goodbye.